Hello, good morning. Welcome to Canara Robeco Fixed Income Update. As usual, we'll start with the geopolitical situation and global market. Geopolitics took a turn for worse over the weekend as Hamas attacked Israelis unprovoked. Israelis have reacted very strongly and are now bombing Gaza Strip on a daily basis. This situation is unlikely to improve in the near term, and coupled with the ongoing Ukraine war, which remains unresolved, the situation globally is again more uncertain than it was a couple of months back. The main impact of this situation is on oil markets, but the uncertainty created by this geopolitical situations also impacts world over globally. Coming to rate markets, situation remains same. The narrative of higher for longer rates still continues. This is because resilient growth in US has led to the belief that inflation also will not come down so fast. The earlier expectation that US growth will slow down considerably because of the large rate hikes undertaken by the Federal Reserve in the last 1.5 years have not really worked that well. Expectation of another rate hike is on the cards, but lately, because of this geopolitical situation, it could be possible that Fed may pause at this juncture. If we look at the US rates, US 10-year went up sharply in the last 3-4 months. From a low of around 3.20 in May of 23, it climbed to 4.90 in the month of September. That is almost 150 basis increase in rates. It has corrected post that, but the rate remains still very high. Now coming to local markets, there is a bit of good news there. There was expectations of inclusion in the JP Morgan Emerging Bond Index for some time, and that event has finally happened. Inclusion in the index will happen from June of 24. JP Morgan is giving a weightage of 10% to India. It would be done in a staggered manner with 1% weightage increase every month and will be completed by March of 25. This is expected to bring in around $20 to $25 billion in the local markets, which is a huge sum considering that India's fiscal deficit remains a bit of a concern, but has been coming down over the years, but still remains high. So this will be positive for bond markets in the medium term. Coming to RBI policy as such was status quo. There was no change in rates, and the stance also remains unchanged. However, there was a bit of surprise from the governor's speech when he addressed liquidity issues. In terms of liquidity, RBI has been trying to manage liquidity, which has been a bit of surplus since the start of this year because of recall of 2000 rupee notes, as well as large inflows which were seen in the equity markets in the first quarter of FY24. RBI in the August policy had increased the incremental cash reserve ratio by 10 percentage points to absorb the excess liquidity which was created for a short period of time. This was reversed in last 1 month in September to October fully. However, it is expected that liquidity will ease in November and December of 23 on back of large redemptions of government securities as well as reversal of currency in circulation as the festival season comes to an end. To counter this, RBI has proposed in the policy that they are likely to do open market sales of government securities. Open market sales is essentially an instrument where RBI sells government bonds in the market to absorb excess liquidity. This is a way of absorbing the durable liquidity from the market on a long-term basis, and it has been used by RBI long time back, not in the recent history. So this was a complete surprise for markets, and yields reacted very sharply and went up from about 7.20 at the start of policy. They ended up around 735, 15 basis move in a single day, which has not happened in the recent past. Because of this surprise, the markets are in an uncertain situation because RBI has not indicated what is the quantum of OMO sales they are planning to do. Also, the timing remains an issue. In this case, markets are likely to remain a bit cautious while on a macro side, inflation has been coming down from the high of 740 we saw in July. We are expecting inflation close to 5.3% or 4% in September. The number will come out in 1 or 2 days. RBI also is comfortable with this inflation, but they have reiterated that their target is now 4% and not 2 to 6%, as was very vehemently put by the governor and very clearly told to the public in general that now RBI is looking at a 4% number from a long-term basis. Uh, the strong growth of Indian economy supports RBI's view because the impact of rates and or higher rates for longer on Indian economy is not that much, and the economy is absorbing the higher rates. So RBI is comfortable holding rates for longer to ensure that inflation trends towards their target of 4% over the medium term, and they can take this opportunity of good growth rates to also look at the policy of bringing down inflation to a reasonable level of 4%. Coming to outlook on rates, like I said, situation remains a little volatile since there is no clarity on the timing or the quantum of OMO sales. So markets will remain a bit range bound around 730 to 35 levels for some time till more clarity emerges on the OMO part of the story. However, on the medium term, we are very positive on bonds simply because one, the inclusion in JP Morgan bond index is expected to bring in 20 to 30 billion of active plus passive flows. Further, possibly this will be accompanied by rate easing cycle in US. Right now, rate hike cycle is near end or ending. Hopefully, it is expected by mid of 24, rate easing cycle would have started. So considering these two events happening together, one is JP Morgan bond inclusion, which will get foreign flows into Indian markets to the extent of 20 to 30 billion dollars, and coupled with a positive rate cycle where rates are going lower, it will be very good for bonds. And while the current situation is a bit volatile, this is also an opportunity for investors to build up portfolios on a staggered basis. Uh, because of the volatile situation, one-time investment or lump sum investment is not recommended. We recommend to investors to put money on a staggered manner for next 3 to 6 months. Things will become more clearer going into New Year 24, and investors can take advantage of this opportunity to invest at higher rates. And we do expect that over next 1 to 1.5 years, rate cycle should reverse, and coupled with the large inflows on back of JP Morgan inclusion of bond index, rate market should do well over next 1 to 2 years. Investors can choose to invest in funds like banking and PSU debt and corporate bond funds. From a risk return perspective, there is a reasonable payoff which is available there. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.